Hello, everybody, and welcome to the next session. We're going to be talking about investors and climate justice. This really is a sort of to talk about climate change from the perspective of some of the worst hit communities in the world who have also suffered from the pandemic. And really, I'd like to be digging deep into what is the role of sustainable impact investment in supporting these communities through the climate transition. And I'm going to introduce our speaker in a second, but just first, I'd just like to remind you you can all share your thoughts on tweets on social media. The hashtag is FTGood. And after the conversation, you can all head over to the event community and there'll be possibility of chatting with other delegates. But now I'm going to welcome Jean-Jacques Barberis, who's executive board member and head of the institutional and corporate clients division at Amundi. Jean-Jacques, welcome. And, I guess my first question to you really is that we're talking about the fair climate or the just climate transition, something that has consequences for everybody. But why is a just transition something that investors should care about?
Yes, thank you very much, Sarah, and welcome to everyone. It's a pleasure being with you. Well, I think first, if we look a little bit back at Glasgow, there was, I would say, an interesting move in the fact that a declaration on just transition was adopted, which I think was an important step that was made on that front. And indeed, so far, I think the social dimension of the transition and the fairness of the transition was mostly in the hands of policymakers for the reasons that you mentioned in your introduction, which is that first, the climate crisis will affect in particular the poorest in the world and the most vulnerable communities. And also second, and it's always important to acknowledge it, that most of the policies that we need to put into place to address the climate change question and mitigation have themselves very strong distribution impacts. And so basically it's at the cornerstone of these two elements that indeed the impact that is generated is in particular on the poorest in the world and within all our societies. Therefore, the question that is mostly for policymakers is indeed why is it a question for potentially for the investors? But first, maybe for the very first answer to that would be for the investors that are truly committed to act and to help to fight against the climate change crisis. I think we shall all acknowledge the fact that there will probably be no transition if not socially acceptable. So therefore, I would say by definition, we need to take that into account. Second, maybe as well, because from a macro perspective, the social dimension of the transition may have some very strong consequences from a macroeconomic perspective, which by definition impacts investors as well. And third, maybe because investors can do a number of things or should do a number of things in their climate change agenda, trying to integrate the social dimension into it. So that would be my three elements of answers to your question. First, if we're committed to the challenge because we need the social aspect of it to make it work. Second, because there are some macro implications that are quite important. And third, because we may have some tools at our disposals vis-a-vis the company we invest in.
Absolutely. And I mean, as you mentioned, a lot of this is a policy question. And, one might feel that investors are slowly sort of removed from that world. Nevertheless, as you say, they've got this, the tool of the companies they invest in. What does that mean in practical terms, in terms of engagement, in terms of trying to push the companies in their portfolios in a direction that is towards climate justice?
I think there is a number of things that indeed investors can do. And before coming to the engagement part, that may be one of the, I would say, very obvious tools that we may have. I think there are also things that we can do in the investments directly. So before even the engagement per se, which is to try to integrate that dimension into the way we invest, which is awfully difficult to do, let's face it, and let's be modest about it, but meaning not incorporating only, I would say, some climate indicators or climate objectives in the portfolios, but also trying to integrate elements of assessment of how companies can participate to a fair transition. For instance, a grid that I like to use is I think a company can participate to a fair transition through 4 types of dimension, through the ways it acts vis-a-vis the society as a whole, vis-a-vis its clients. For instance, It's very nice if you're an electric car company to build up cars that cost a lot, but if they are not affordable for I would say, mass of the population, are you really participating to the transition challenge? I think that's a question. So there is an issue about the fairness of the product range, if you allow me the expression. Third, it's vis-a-vis the employees themselves. Very concretely speaking, if you're an energy producer and if you're going to close some of your production units because they are no longer compliant with the 1.5 degrees Celsius scenario, does it mean you're going to fire all the people in, or does it mean you're going to invest into human capital to prevent that to happen? And there might be a fourth dimension, which is vis-a-vis the communities where the companies are invested in. Exactly same example as before. What do you do to address the fact that if you close some units somewhere, this may have very strong impact on a territorial basis? And I think there are possibilities to integrate these dimensions in the very assessment we make of companies, and then trying to integrate that in the management of portfolios. It is challenging. It's not easy. We try to test it on our side in some methodologies, but I think at least we shall all try. And second, I would say type of action is indeed what you mentioned, which is the engagement part. And therefore here, I think our very first role, a number of investors are now more and more vividly engaging companies, asking them, let's have an SBTi target that is approved, validated. Okay, and this is absolutely needed. This is crucial. But then the second part of the conversation, from my perspective and from Amundi's perspective, should be, okay, and with it, that transition agenda, how do you address the fairness of the transition into your plan? The answers will differ a lot depending on the companies, and it's not that easy to do. But clearly, I think through the engagement, there is first a role for investors to make sure that the companies are progressively aware of that, and second, to discuss with them what they can do, and as well in the engagement, trying to define what will be the indicators, what will be the appropriate data that we may use afterwards, because the situation so far is clear. It is a dimension that is difficult to address.
And I mean, it sounds like from what you're saying, really, an ESG lens alone is not enough. We need to dig deeper.
I think it's the ESG lens for me is the base is a basic, and then afterwards, if you want to try to address properly the challenge, probably you need to go a little beyond that. First, to integrate fully the climate alignment in what can be done. This cannot be done in all portfolios, but I think working on progressive alignment first, and second, it's detailing a lot some elements that may be embedded in the S part of the equation, and trying to find the one that are in direct connection with the transition agenda of the company itself. So indeed, it's complicated. And I think here, if I may have a little, not call to action, but an invitation for the audience, with a number of peers, we launched a coalition of investors for a fair transition. That is an engagement coalition. So far, it's relatively modest because it represents a little more than 4 trillion. In dollar, it would be probably now near to 5, but it's still not enough. So we need more people to join and to help us to build that common agenda vis-a-vis the companies we're investing in.
So it's that power in numbers is going to get us there, and presumably some better measurement tools will evolve. How do you see that happening?
Yes, but I think here that refers as well to the overall, I would say, debate on ESG and what are, I would say, our measurement capacities. But here we're talking about something which is probably even more complicated, because the social dimension of it is probably more, let's say, complex to grasp, and probably also where here you have cultural visions that may be different. More and more, I think, on climate indicators, we're converging on the fact that this is the right indicator, this is the right metric that is associated to the challenge. The definition of what is socially acceptable may differ a lot on a transatlantic basis, even if you cross the channel, even if you cross the border between Italy and France, or France and Germany. And so I think one should acknowledge that this is as well an issue to define properly what the right indicator should be.
Absolutely, there are cultural differences. Well, that's all we've got time for in this particular part of the session, but please stay with us. We will be joining other panelists in a few minutes, and we'll be continuing the discussion. Thank you very much. Hello, everybody, and welcome back. We are discussing investors and climate justice. I'm going to be welcoming the other panelists to the session in a second, but for those of you who just joined, as a reminder, you can post questions on the Q&A box at the bottom right of your screen. We'll get to as many as we can. Please do share your thoughts and tweets on social media using the hashtag FTGood. And then after the conversation, you can head over to the event community to chat with the other delegates and continue the conversation. But now let me just introduce our panelists. We've just had Jean-Jacques Barberis joined us earlier, but for anybody who missed that session, he's executive board member and head of the Institutional and Corporate Clients Division at Amundi. We've got Susan McCormack, who is a corporate partner at MoFo, and we have Anne Simpson, who is managing investment director for board governance and sustainability at Calpers. And I'd like to start with a big question, which we touched on a few moments ago, is that given climate justice is quite a high-level policy matter, what is the role of the investment community in supporting things like improved safety nets, clean energy sources that are affordable, that might actually help us prevent a populist backlash, particularly in an era of inflation, against the green transition? What is the role of investors? And perhaps maybe you'd like to start with that.
No, thank you very much. This is an absolutely fundamental question. So first of all, with Calpers, some years ago, we recognized and we set it out in our investment beliefs, long-term sustainable value creation requires the effective management of three forms of capital: financial, physical, and human. So everything we're looking at, not just the climate change transition, we need to make sure that we've got the reporting, the policies, the frameworks in place to ensure that people are being taken care of. Specifically on climate change, we need to go back to the original text. If you read the preamble to the Paris Agreement, you see very clearly the just transition is set out, and it specifies that the transition needs to be planned in a way that's not going to harm vulnerable communities. That means the workforce, indigenous peoples, those in the supply chain, the impact on migration. So all we're doing in now building out a just transition framework to these plans is fulfilling what was originally agreed to by the Paris Agreement. This is not some bright idea that was invented in Glasgow, but as Jean-Jacques said, it has now come to the fore. So in practical terms for investors, what that means is integrating an assessment of the just transition into our appraisal of company risk and return on these issues. And to measure it, we've developed a benchmark called the Net Zero Company Benchmark as part of Climate Action 100 Plus. This is a $60 trillion alliance of investors, which many of those involved today are part of. And we have just integrated the just transition into that net zero company benchmark. And it's based on ILO guidelines. It says essentially we want, first of all, companies to acknowledge who is impacted by their transition plans. Secondly, to consult on the transition plan. And thirdly, to report. And that is a starting point for us to begin to assess the impact on people. Because as you rightly say, I mean, even look at the Glasgow discussions for the American delegation, the big concern was looking at West Virginia and the impact on coal communities of what the administration wants to achieve with climate change. So this is not just an issue for developing countries. Even getting the G20, the G7 over the line means we've got to be able to take care of the workforce and communities. And also in the transition to new jobs, it's been pointed out more than once, if you're trading off well-paid jobs with benefits for health and pensions, particularly in the United States, where this isn't taken care of by the government, you have got to make sure that people have still got a living wage and the benefits and protections that are going to actually make this viable for communities.
Yes, interesting. I mean, Susan, this is a new. We've had companies sort of get their heads around ESG and getting that into investment portfolios. This is an even deeper level, isn't it? What do you think are the challenges for investors who are coming to this as a new topic?
It's interesting. I think before I hear, Anne, that it was always part of climate, but the investors that I work with really until a couple years ago distinguished between people versus planet. They were either focused on environmental and climate, or they were focused on people. And I think what was ignored is not just what Anne is talking about, which is the ramifications of investments, of development, of the operations of business, but also quite frankly, in the US and around the world, we really have two completely different economies. We have the economy that, even with the stock market this week, is going fairly well. And then we have the economy that was already hurting, was decimated by COVID, has not been rebuilding. And the example, I'll give is low income housing. You have something incredible like 90% of low income housing that is being built right now in climate insecure areas. So the economic cost of that to business, but that is certainly not a just transition. And I'm not sure, Anne, it can be accounted for in current investment philosophy, current investment rubric, because most of the investors who are investing heavily in the energy transition may not be the same investors who are investing in low income housing. And so this is why, and I can talk about it now or a little bit later, I think there are some new tools that need to be adopted by investors to think about how they can encompass sort of all countries, all regions, and particularly low income communities as we move towards energy transition and net zero.
Yes, and Susan, I mean, perhaps that's the moment to dig into this. I mean, how could donor funds help secure more private investments and bring some funding into these credit and other sort of financial services needs of these low income communities? Talk about some of the structures that are out there that could be used.
I mean, the point that I often make is philanthropic capital is less than 0.5%. So we can't solve these issues. I think this is why what the Armundi folks what Anne is talking about, this has to be structured into the fabric of normal investing, number one. But number two, there are huge sections of the economy and our world that need sort of special attention. And here, again, it can't be solved with philanthropy. So what do? And the structures that we have been focused on are where you take a little bit of government money or a little bit of philanthropic money, and then you marry it with mainstream capital in the form of either guarantees or loans, either guarantees or first loss capital. It used to be called blended finance. This is slightly different in terms of aggregating capital, and particularly aggregating capital outside of the traditional fund structure. I'll just say one of the huge issues we have is that funds obviously make money on money, and funds have a lot of compliance cost in the middle. And so we have been toying with structures that try to eliminate all of those sort of middleman costs. So you can take mainstream capital, a first loss or a guarantee, and then you can on lend into the communities. We actually use CDFIs, which I'll talk about later, into the communities at very, very low rates. so that they can rebuild. And you can aggregate those funds either alongside. There are a lot of investors who are setting up sort of sidecar funds, or they can be participants as one of the sleeves of capital into these alternatives. I would say what I don't like and is still being used is the bundling and selling of loans, i.e., let's get loans for infrastructure with low income housing and bundle and sell them. One of the huge issues is, again, then you have lenders that have direct recourse against the small business or against the homeowner. I remember 2008. Hopefully others do remember those lessons as well. So the on lending as opposed to the on selling of loans as a viable and I would say a much more effective alternative.
And are there areas you think that we could, you mentioned that, I think it's very interesting, the balance between investment and philanthropy. And as you say, philanthropy or donor funding can be a catalyst. Are there going to be areas that just simply will not lend themselves to investment capital at all in the just transition? Susan, I just followed that up with you.
There are some, and that's where the majority of the grant funding would apply. I think most of the transition to net zero can be handled with the aggregation of these types of funds. So it may not be able to have high return capital, but it certainly can attract sort of muni rate capital, banks with community reinvestment dollars, foundations, large corporates that want either just a return of capital or a very low interest rate. So, not private equity, or venture, but there is a lot of capital out there that could be devoted. And I'd be interested, I think there is some interest, and I'd be interested in sort of from the institutional investor side, from Anne and others, I think there is some appetite there as well to provide a lower return funding base for some of these alternatives. Again, if you have the first loss or the guarantee, so that that you're going to get your money back. You're not losing the retirement funds, but you may not be driving for as high returns.
Interesting. Anne, what is just to follow up on Susan's question there, what is the appetite in institutional investors for that kind of those kind of mechanisms?
Yeah, so the first thing to say is there is a social purpose to a pension fund to begin with. And, we're taking care of the retirement savings for 2 million people, many of whom this will be their main source of income. Whether they're out of the workforce for disability reasons or contributing to their healthcare. But, typically the pension people draw from Calpers is $3,000 a month. So although with this vast fund with almost $500 billion, when it comes down to it, we've got to invest to pay 55 cents on every dollar we pay out. And currently that's running at about $25 billion a year in cash that we need to generate. And then to meet our liabilities going forwards, we need to generate, our current discount rate is 6.8%. So the different asset classes have different purposes and obviously different benchmarks, but we need to understand as fiduciaries that this money already is dedicated towards taking care of people. Now, the question for us in the just transition is making sure that we're not generating these returns off the back of some exploitative model, and also that we're taking care of the externalities that are created in the process. So the way that, just to pick up on what Suze was saying, I fully agree with her. As you nicely put it, the catalytic role of either public or soft finance of some sort, that really does play a role. But to access the institutional money, you've got to be able to meet the fiduciary investment goals, particularly on a pension fund like ours. Now, another pension fund, look at GPIF in Japan, their discount rate is 1.7% because they don't have current liabilities. And, their investment objectives are set through them being a buffer fund to the Japanese economy. So start with the investment objectives of the fund, and then there's a mapping exercise to do to put the supply and demand together. What we do around our real assets and infrastructure portfolio is we have, first of all, a responsible contractor policy so that we are tracking wages, benefits, neutrality during unionization drives, for example, for any contract that's issued that's over $100,000. So it's set at a very low level for us. We have close to 100% compliance with that policy, which is very important. So first of all, take care of business in your own portfolio and the impact you're having. And on the climate change side, which obviously interconnects very closely, we've got energy efficiency and energy optimization targets for the portfolio. And what we've found in combination, taking care of the workforce and making sure we are really best in class on energy efficiency, water storage, both the people who are servicing building, constructing buildings, and then the tenants. This comes together into a very good investment opportunity for us. So we can meet our financial goals and take care of the human capital agenda and make sure that we're living up to the rhetoric on climate change and so forth. Now, it's more difficult in private equity because, in our real assets, we are in we've put ourselves into being mostly a fund of one. So the question then is what happens in private equity? And most of the discussion so far has been about companies in public markets, including by us, I would say. So we've just launched a new project in the private equity market called the ESG Data Convergence Project. And the purpose of this is to start putting basic metrics in place for general partners to report into limited partners. We'll have the first results in April, and that is covering the obvious climate change agenda of emissions, reliance on renewables and so forth. But we also have built into this initial range of metrics, net jobs created, health and safety, employee engagement, and diversity. So it's another example where what we're demonstrating is that the investment case is there for having this holistic approach to sustainable investment.
I mean, I think we're
maybe,
going to get into a discussion about measurement a bit later, but perhaps Jean-Jacques, but just to follow up on that, what is the strategy for the kinds of things that Anne was talking about there across different asset classes? How are you building portfolios that really kind of incorporate climate justice, not just as a sort of add-on, but as a deep part of the portfolio construction?
Well, I'm not sure we are perfectly doing it. I think we try first to be fair. Just one thing, coming back to something very important, Anne has mentioned at the very beginning of her intervention. I think it's important as well to remember indeed that the fair transition question is not a new subject. It's historically comes from the vocabulary of the unions in the US in the 90s. So this is something that is, I would say, now starts to be a relatively mature concept, for very different reasons. And I very concur with what has been said before. It's really not to oppose the social and climate dimension. There's a very famous unionist in Europe who has said that there are no jobs on a dead planet, which I think are really showing very well the sentence, how that makes, I would say, the challenge measurable. Coming back to very more concrete things on what you just said, but on the measurement questions, by definition, it's not easy. I agree with a number of things that have been said. The types of, I would say, indicators or measure we use when we try to build up just transition solutions will be quite close to some of the ones that Anne mentioned. So for instance, net creation of job out of the transition and the capex invested into transition solutions. That would be one. The investment in human capital would be as well one. For sure, that we would use in particular for, I would say, companies or sectors that are facing very, I would say, challenging transition agendas in some activities. The worker skill development will be one, and something also that we think is extremely important is the social dialogue within the companies, because in a way, in a company, it's just like within all our societies, and I think it's only possible to address the climate challenge if you're in a society that is socially peaceful, if you allow me the expression that may be not perfectly proper in English. And I think this is the same in a company. If you want a company to engage really into a climate transition agenda that is meaningful, you need to ensure that socially within the company it works, and that the workforce is associated to the plan. And so therefore, an indicator we would use would be the type of social dialogue that is run within the company, within some metrics, using some metrics. For instance, do you have some representative of the employees at the board? What is their role there? This type of assessment. And we think it's also a very important element of the assessment if a company has the capacity and the alignment of interest and the proper governance to engage into a fair transition agenda.
And Jean-Jacques, just to follow up there, I mean, what we're talking about also with the just transition is a lot of levels, and you touched on this earlier, that are really policy matters. I'm talking about a carbon tax, a carbon price, things like this that have a material effect on communities. What do you see as the role of both the companies you invest in, as you as an investor, and perhaps as part of this bigger coalition that you're building, in engaging on the policy level with climate justice?
Well, it's a very broad question. Speaking in France, I speak from a country where basically the yellow vest protest started because of the increase of the carbon tax. So in a way, I think we had a live example of the social dimension of what the transition could be. Well, I think it's important for investors to acknowledge what they can do and also what they cannot do. There are things that we cannot do, and there are some responsibilities that are for policymakers, for very good reasons, by the way, because they are elected and they have the legitimacy to do so that we may not have as in an investment community. So I think there are some issues that we cannot completely address. One that was mentioned, for instance, I see a lot of, for instance, of the finance needed for pure adaptation purposes to be delivered by public finance in particular. I think this is a role where there might be things that can be done at the private level, but clearly this is a role for public finance in particular. And so I think we shall be conscious of our role and our responsibilities, and also of the consequences of what we say vis-à-vis policymakers. I give an example. The investment community is quite vocal in saying that we need a carbon price, the maximum possible, to make sure that we integrate fully the question into our investment decisions, which is absolutely true from an economic perspective. That has absolutely massive distribution impacts. And we need to be conscious then when calling for that. These are some distribution impacts that needs to be taken into account. So I'm not sure we are fully in capacity to ensure, for instance, that ultimately this impact will not affect, I would say, the poorest part of the population. I think what we can do is probably to deploy capital and invest into solutions that make the transition affordable and accessible to a number of people. And here I think there is a role to play, a positive contribution of what we can do. And so I think it's on this area in particular that there is a role and that where capital can be deployed.
Yeah, interesting. And Susan, what's your view on, what can, as Jean-Jacques said, investors can do certain things and they can't do other things on the policy level. What's your view on how the investment community should be engaging at a policy level?
I think I don't want to repeat what was just said, because I think they're very, very good points in terms of how investment is deployed that Jean-Jacques was discussing, and what Anne is talking about from sort of the institutional investor perspective about how they're screening and what they're requiring in connection with the investments and how you measure that. I just want to take a step back, and one of the things that I am seeing is, let's go to the investment managers and the form, that most of them are set up as funds, again, that charge fees and are structured for a purpose that doesn't necessarily align with a fair transition, to be blunt. There is no built-in incentive. Jean-Jacques just talked about alignment. There are no built-in incentives, unless their LPs require it, for them to really think about not just the impact of their communities. There's a reputational risk or a compliance risk, but also how you address, which Jean-Jacques says, sort of needs to be filled with public funding, but I'm just not sure there's enough public funding. So one of the things that I'm seeing a lot of, and I'll give 3 examples, is really looking at the form of the asset manager itself. You have some asset managers that are moving to a more permanent asset structure so that they have more flexibility in terms of how they deploy. In the US, you have asset managers like Generate Capital that are converting to the Public Benefit Corporation in Delaware, again, distinguished from the B Corp. The Public Benefit Corporation requires that the board and management, that the managers, the asset managers, they have a fiduciary duty. They have to assess the impact of their investments and their operations on all stakeholders. So beyond shareholders, it's kind of it is a direct, a direct counter to the shareholder primacy. So the form that they're taking is one. Number 2, let's go back to the alignment. What we're seeing a lot more of being requested and then sometimes required is structuring the compensation and payout and carry so that it is tied to both financial and impact, right? So you are looking at what Anne is screening for, and you are requiring your asset managers to ensure that they don't do harm, or in fact that when they set the goals, whether it's goals around D&I, whether it's goals around improvement in low-income communities, that they're held to task. And the third, where we've seen the most sort of, especially in the private equity world, the most innovation is sort of a sidecar impact fund. And to me, this is relatively easy. You pool capital to run alongside, but it just has incredible potential in terms of how you could have a mainstream fund and then have an impact fund that has some concessionary capital, that is able to invest in communities, we're doing several impact funds that are investing in tribal lands that can't require the returns, but enabling them with the financial rigor of a normal investment and fund can really help, because as I mentioned earlier, grant making can't get us out of this. And in many of these communities, grants can be stopgap measures, but really low interest loans to businesses, to communities, building infrastructure within these communities. You're really doing the regenerative ag, again, that Jean-Jacques mentioned, can have just incredibly positive impact, not just on those communities, but on climate as a whole.
Yeah, and that raises an interesting point in something you said, Susan, because we've got the capacity of asset managers here. I mean, Anne, what are you seeing in terms of this is complex stuff, a lot of this, and not just talking about climate change, but climate justice. What does that mean? It's not an easy issue. It's not measurably easy. What are you seeing in terms of the skills within the asset management industry themselves and the capacity to understand this topic and to integrate that into day-to-day decisions?
No, thank you. That is such a good question. It's sort of the human capital management issue coming home to roost on Wall Street. And right now there is a gold rush. I speak advisedly from California here. There is a gold rush on ESG. And there's a massive amount of staffing up, salary inflation, expansion of marketing budgets, and you name it. And of course, part of what that has prompted, rightly so, is concern about ESG washing, or, I think of this as snake oil, which is as old as the hills. And you look back into the law cases. Suze might well know this. She's a lawyer, unlike me. The early litigation around snake oil salesmen was to complain about the fact that there wasn't a quantity of snake involved in the product. That was the first legal complaint. Later on, it became, hang on a minute, the snake oil hasn't made my hair grow back, or anyone fall in love with me, or, dealt with my rheumatism. And it's almost like we're following that same trajectory, which is the marketing's there first. ESG is the panacea for all that ails thee, whether it's in your portfolio, wider society, and the economy. But as Jean-Jacques said, we have to have a very clear sense as fiduciaries as what is our role in the midst of all of this as fiduciaries to generate these long-term returns. So there's some things we can pick up and other things we can't. I think the question about the recruitment is really important, and is, I think, notable that the CFA has now developed training and modules into their qualifications, which are required for most financial analysts, and I think that's a very positive move. We're also seeing business schools integrating these issues into their MBAs and their finance classes. I teach at Berkeley and at Oxford, and I can say in both places, and Sue's teaches at Berkeley as well. This is now centre stage. For understanding, you can't have one team looking at finance, another team looking at human capital, and another team looking at natural capital. It's all got to be integrated into this holistic set. So we've got some teething trouble at the moment as these different disciplines come together. But as Prince Charles quipped some years ago, we need investors who can speak fish and finance. Now, there's also pressure from the asset owners on the asset management industry, not just designing mandates. And I think GPIF really was in the lead with all of this a few years ago, but also by filing proposals at the asset management companies that are listed. And really important to note, I think, this year, 2021, was share owner proposals coming forward on, for example, the financial institutions doing a racial equity audit. Think about that in terms of scale and impact. You think about the role of the big Wall Street lenders in terms of mortgages, access to credit, investment, and so forth. We've got the CRA requirements have been in place for a while, but to their credit, BlackRock said, "Hey, we don't need this vote. We'll do it." The proposal was withdrawn. Likewise, these proposals got very high votes at Goldman Sachs, at JP Morgan. So this is really where the asset owners are starting to understand that the internal operations and decision-making of the fund management industry itself is something that needs to be tackled. And if you think about it, really this is investor governance is the next big thing. The next big thing. We understand corporate governance and its importance, but the question of how asset owners make sure that their interests are being reflected right through the investment chain, it's governance sauce for the goose, just as it is for the gander. But that is going to really, I think, going to put pressure on the fund management industry to raise its game in terms of credible reporting, standards, assurance, and aligning compensation, or remuneration, as it's more politely called in Europe.
Yes, interesting. Well, as Anne mentioned there, we're in this period of capacity building, really. Jean-Jacques, how are you seeing that playing out in across Amundi, and in terms of the ability to recruit and develop the professionals with the right skills to deal with these very complex issues?
So I would like to say I very much agree with what Anne just said, and also I think there will be more and more pressure on our industry. Also, for a basic reason is that this industry is actually at the moment extremely demanding as well vis-a-vis the companies we invest in. In a way, if Amundi requests more and more from the company we are investing in, have an SBTI targets, have a say on climate voted at your general shareholder meeting, make sure that the KPIs of your CEO and your top management is aligned with such a plan, why shouldn't our own investors ask us to do the same within our own company? And so I very much concur with the fact that we will see more and more, I would say on climate by asset managers themselves, which is not an easy thing to do, and more scrutiny made by our own investors into the way we align incentives. And here, I totally agree with what was said by Susan. I think it will be a lot regarding, okay, what is the compensation policy do you have in place? If you're serious about what you mean on that front, do you have a very important part or an important part of your compensation policy at top management level, but going down to the investment people potentially or elsewhere, that is integrating these issues or not? And I think this is a fair question that we're going to have more and more. I agree as well on the fact that I think that we're entering progressively into a debate on ESG where now it's becoming a mature subject, and therefore that regulators are paying attention to, which is for good, I believe. It's important that that the regulators are helping a lot, if you allow me the expression, to pass the vacuum cleaner on the subject. And therefore, is it really ESG into it? Yes, that's the first question that I think we will have. The next question afterwards, which is going to be even more complicated, is what is the intensity of what you do? And the third question afterwards is show me the results associated to it. And I think we're exactly on that path, and for good. I think it's a good element of pressure on the industry to show that it is in capacity to deliver. So at Amundi, I think we were announcing our new, I would say, plan on ESG for the next 3 years next week. So I'm not sure we're going to meet all the challenges that have been expressed in this panel, but at least we try to take some of these into account. Where I think we are facing a true question, which is a very interesting question, is, as it has been mentioned, we don't need only financial engineers or specialists anymore in the company. We needed other types of talents before, but now it means you need engineers as well. If you want to be serious about, I want to understand what is the transition path of some sectors, how can I do that if I do not have the people that have the capacity to challenge, I would say, the company in front during the engagement? So we think definitely new types of skills that we didn't have in the past. And when it comes to the social dimension, even some skills that could be perceived as very far from the investors community, so coming from social sciences or these kind of things, that needs also progressively, I think, to be incorporated in the human capital we manage. So honestly, I think it's a beautiful challenge to have, because it implies a lot more of diversity and capacity to think the world as it should be within our industry. So for me, it's a really nice challenge to have.
Well, interestingly, we've got I think, related question from the audience here on governance and the concept of governance. Can you see how? Can you just explain a little bit more about how governance is playing out and how it might become mainstream in the finance industry? This is a question from the audience. Susan, would you have a response to that one?
I can, and use the term governance to describe what I spent 10 minutes dancing around. That's exactly what it is. We're looking at ESG from from the investor perspective, and institutional investors are starting to look at the asset managers and saying, okay, great that you're requiring more diversity, great that with respect to your portfolio companies, great that you are ensuring that they create jobs in low income areas, that they do climate risk scenario analysis. What about you? Where is your diversity? Where is your commitment to climate? How, if you are paying yourself $100 million, how are you committed to the just transition and employee pay? So I think that conversation has been long in coming. Noting that I'm a corporate lawyer representing a lot of private equity, it's a little against my self-interest. On the other hand, what we are seeing, and actually we did a 6-month study with Stanford. I do play around with Stanford in addition to Berkeley, looking at all of the devices that funds were using kind of at the cutting edge to align their governance. And that is ICM, and you can look, it's publicly available. So we actually went out and interviewed 50 different funds, and what are the tools the new tools that they are using in governance, and how are they working for them, whether it's remuneration and compensation, whether it is the corporate form, as I mentioned. And I would say Generate Capital was early with the permanent asset vehicle converting to a PBC. There are now many more PBCs, again, the public benefit corporation, not a B Corp, which is just a label, but really where you're shifting duties, where you have an obligation to consider stakeholders in addition to shareholders that can be very aligned. I mean, the institutional investors and return first investors can invest. It's nuanced, but very, very important in terms of how they operate and how they embed ESG. And those are becoming, I mean, 10 years ago, Anne knew me then. I was trying to convince people to even have a conversation with me about it. And now a lot of people want to discuss how these can operate in the mainstream in addition to kind of concessionary capital vehicles. In other words, how can they still be used? Because and Jean-Jacques can speak to it. At the same time, you're going to start, changing your compensation model. You still got to be able to attract the top talent in, and we want you to have the best talent to make the best investment decisions. And so it is difficult, but it is gathering a lot of steam.
Yes, Jean-Jacques, how do you see that balance being struck between compensation and getting the right talent in?
As you mentioned, I think indeed it's a balance. It's a balance. What I can say, but here I think probably if I have colleagues from Amundi listening to that panel, that probably will kill me afterwards. But I don't think that Amundi is the most aggressive company in terms of compensation, and I think we're relatively well known for that, and to have, I would say, try to have an approach of compensation which is indeed to attract the best talents, and at the same time being conscious in a way that we try to find equilibriums and participate to the equilibriums in societies we live in. So I think this is a balance to be found. And I think Susan mentioned things that are extremely advanced in terms of potential assessment of a governance to be efficient or not to deliver on these type of challenges. I think there are also some very basic questions that can be asked to people like us already, which is just a very basic one that a number of consulting firms are asking, for instance, is where is your ESG department? Is it attached to marketing? Is it reporting directly to the CEO? Is the person in charge of it a member of the general management or not? What is her or his capacity to act vis-a-vis the rest of the organization? Does it have the capacity of independence to potentially get rid of potential conflicts of interest? I think before even getting into these very sophisticated questions that Susan mentioned, I think a number of these very basic ones are not yet totally asked to our industry at this stage. I'm not sure I'm going to be extremely popular by saying that, but I think these are fair questions that should be raised, and more.
Yes, and how do you see governance being embedded in terms of the journey we're on regarding compensation, skills, this kind of thing? What would be your follow-up to that?
Yeah, no, and thanks to Susan, Jean-Jacques, they've made very important points. I would say investor governance right now is the missing link. And I think the reporting issue's been well explained. The compensation remuneration piece has been well explained. I would also say for Calpers, given that we're civil servants, I mean, we're a public agency. So I would say and we invest 80% of the portfolio is internally invested of a almost $500 billion portfolio. And I think our ability to recruit is because of purpose, and on top of that, work-life balance. And being in California, we know what, Suze, this is very much your world, Silicon Valley. I know for sure that we recruit some of the brightest and best who are looking for the purpose that Calpers can offer, but also a defined benefit pension scheme and a health system and European style leave policies where you have 5 to 6 weeks paid leave a year. And we have bicycles for loan on the premises and a childcare centre on site. So I know when we're recruiting, it is around this concept of purpose in finance, and also around a set of core values in the way that we do our work that actually is our advantage in recruiting. It's not about, we can't compete with Wall Street in terms of the amount of money we dangle in front of people. So for this type of work, I think that's a real advantage. But I think for many investment institutions, they don't have something which for Calpers, it is sort of just baked into our governance system. Like, first of all, our governing board is appointed and elected by stakeholders. You know, the state treasurer, the state controller, the legislature, people who represent the taxpayer who carries the burden of risk if we don't get our numbers in order on the investment front. They're on the board. Likewise, different categories of our membership elect board members. So our current board president, Henry Jones, is elected by the retirees. Of course, once they all land in their role, they're fiduciaries. But the sourcing from these different parts of the stakeholder community in the governing body of Calpers, I know, is why the board is sensitive to these bigger questions on sustainability. The other thing is our investment committee meetings are held in public. You can come in person, so long as you're wearing a mask at the moment, or you can dial in and ask questions. So there's a level of transparency to Calpers' decision making, which puts us under the spotlight on a almost weekly basis. So some of that thinking needs to be extended, I think.
I think that's such a good point, and this holding the investment industry to account is going to be critical. And I think, as Susan pointed out, we may well see more of the financial sector becoming public benefit corporations, which is another method of holding everybody to account. Really, sadly, that's all we've got time for. I'd really like to thank my panelists so much for a great conversation, and for watching, please continue the conversation on social media, FT Good, and the sessions will actually be available on demand for a month on the site event website, so you can watch them again. And please head over to the event community area to chat with other delegates. But just to reinforce, thank you very much to my panelists for a great discussion, and we look forward to continuing the conversations. Bye-bye.